The key is to set the overall call's strike price at or above resistance so that any existing sell orders that professional traders have out there that are still in play from the last time we were at that resistance level, so that those sell orders can absorb the buy orders and therefore prevent the stock from rising, which therefore helps to protect your covered call. Of course, we can't be sure the sell orders will still be in play at that same resistance level in the future. But empirically, the presence of a resistance area tends to repel stock advances more so than pure log normally distributed stock prices would statistically. So resistance, and again, it's basically the same thing for support, gives investors an edge above and beyond randomness.
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hey, Wealth Building family. Welcome to episode 52, Wheel Trades That Don't Suck, Part 2. But before we jump in today, let's talk about how you can get the most out of the Wealth Building with Options community. First, make sure you're subscribed to the show in your favorite podcast app. You don't want to miss anything. And if you're already subscribed to the show, you can go even deeper and get more out of what we talk about with a paid subscription. With your paid subscription, you'll get video extra podcast episodes, so you can get hands-on video training on things we talk about on the show. Subscriber-only posts, where I drill down on a stock, event, or trading opportunity and share trade ideas. You'll get all my covered call and cash-secured put trades that I'm making in my real brokerage account. You'll get access to our monthly online Ask Me Anything webinar, and you'll get our unusual options activity alerts on options income trades like credit spreads and much more. And the best part is your paid subscription helps keep the show on the air. So I'd like to take a minute to thank our newest paid subscribers this week. Thanks a whole whopping bunch, and welcome to being a paid subscriber to Gina V, to Dominic N, to Alberto L. To join this list of Wealth Building paid subscribers, just go to the Wealth Building with Options Substack page and sign up. The shortcut to get to that page is wealthbuildingpodcast.com. That takes you right there, wealthbuildingpodcast.com, and choose a monthly or save some money and get an annual subscription. Or for the best value, become an all-in wealth builder and get everything I mentioned, plus our Friday group coaching, our Smart Income video class, and get on the wait list to get a signed copy of my new book, Build Consistent Wealth with Options, scheduled for release on April 28th of 2026, right around the corner. When I began recording the episode last week, I had no idea I had so much to say. But now we're really in the part of the book that has a lot of meat. I mean, the whole thing is important. I put a lot of great stuff in there. But the chapter I'm pulling from for these episodes now kind of goes to the heart of everything the book is about. I didn't set out to write another plain old covered call book. I set out to create something truly useful to investors. Most books on the wheel just explain the system. They oversimplify it. And they skip over all the stuff that's required to do to actually make them work, to actually make them, well, not suck. So we're taking this apart today like a toddler with the TV remote. Let's bust this sucker open. As we've explored, covered calls and cash secured puts are synthetically equivalent, right? And so a lot of the techniques for analyzing the viability of cash secured puts is going to be the same thing for analyzing the viability for covered calls. Even so, in practice, those two types of trades, they're used a little bit differently much of the time, even though they're synthetically the same. Because investors sell puts to buy the stock and sell calls to sell the stock, they tend to handle cash secured puts and covered calls, respectively, and think of them differently. The parts of the viability analyses of the two strategies are pretty similar regardless. Maybe not quite identical, but they sure do have a lot in common when it comes to the optionality of each of them. With covered calls, we think like an investor, just like we do with cash secured puts, only we're already in the investment when it comes to a covered call. We already own the stock. Similar to put selling, we focus on an annualized return when we're planning to skate on the call this time. And we focus on a value-based strike target when we have the objective to trade, to use the call to sell the stock. But here, the target is the price at which to sell out of the stock when we're talking about covered calls. And we want to count on and account for the cumulative discount effect that is oh so important. In some ways, it's harder to pinpoint a specific exit price for a stock than it is to target a specific price to buy a stock, like we would with cash secured puts, for example. Excellent intrinsic value investors who create a range in which they think the stock is valued to live somewhere between the high and the low of that range so that they can have some margin of safety below that range and to buy it and margin of safety above that range to sell it. But what exact PE ratio would warrant selling the stock? If we're not looking at the intrinsic value range. Setting such a target, it's not crazy talk. It's not an impossible thing to do, but it can feel, and it can actually be, a little less precise for the ratio-focused investors instead of the intrinsic value investors to pinpoint those exact ratio values when using them to target stock prices at which to, in this case, exit, because today we're going to talk mostly about covered calls. I would go as far as saying that things are probably a little easier for the investors who have the skate objective with covered calls because technical analysis is your BFF for covered call skate objective traders. Resistance, momentum oscillators, and range defining indicators, these technical tools are really, really great when it comes to using TA for covered calls when you're trying to skate. We've talked about support last week, or maybe it was the week before. I think it was last week. Today, we're going to talk about resistance. Resistance puts a speed bump in the road of the log normal distribution. The key is to set the overall calls strike price at or above resistance so that any existing sell orders that professional traders have out there that are still in play from the last time we were at that resistance level, so that those sell orders can absorb the buy orders and therefore prevent the stock from rising, which therefore helps to protect your covered call. Of course, we can't be sure the sell orders will still be in play at that same resistance level in the future. But empirically, the presence of a resistance area tends to repel stock advances more so than pure log normally distributed stock prices would statistically. So resistance, and again, it's basically the same thing for support, gives investors an edge above and beyond randomness. That is super powerful. Next, I want to talk about momentum oscillators. I find momentum oscillators are pretty valuable for selecting strikes that are likely to end up being short-term tops so that we can sell covered calls there. The momentum oscillator that I personally like the most is the relative strength index. That's the RSI. And I use that basically in two ways. And I talked about this in a previous episode. For me, the two main ways that I use it is looking for an overbought scenario on a pullback and a divergence level. For the overbought area, when the RSI line crosses above 70 into overbought territory, I still take no action. But then once it crosses back down below the 70 line, that's where I feel really comfortable putting in a covered call not too far from the money, because we usually get a few days pullback. And if we get a few days pullback, it just moves it farther away from making new highs, farther away from going through the strike. So it's valuable. I've also used the average directional index, or ADX, in the past also. And I use that one pretty straight just to see when momentum is getting less strong, when it's waning. And then there are range defining indicators. Now, these are really, really good for covered call skate trades. Again, I always remind people, skate trades are when we have the objective to not get assigned and just keep the premium. When we're looking at wheel trades, it's useful to have context as to what the range for the underlying is likely to be between now and the expiration day of the options being considered for the trade. There are several ways to calculate expected ranges. As option traders, what's one of the first things that comes to mind when we're thinking of a range? The amount of volatility. Well, if you're like me, probably your mind goes right towards volatility analysis, right? I'm not sure a classic chartist, like an old school technical analyst, would call volatility an indicator per se, but option traders like us who study volatility closely, we know that it can help indicate a potential range for the stock regardless. Consider that the implied volatility and historical volatility alike are stated in terms of annualized standard deviation. In practice, option traders figure standard deviation means there's about a 68% chance of a stock staying between down one standard deviation and up one standard deviation. Now, I do want to point out here that that just means that there's a 68% chance, whether we're basing that off implied, presumed future prices or historical past prices that we think are going to continue. So it's not really like resistance or support or anything like that. It doesn't really put a bump in the road of the log normal distribution. It just says, 68% chance. So that's some information, and it is somewhat useful. So let's talk a little bit more about how we can use it. When we're talking just covered calls and not skating on them, what we're doing is we're kind of disregarding the bottom part of that range. So considering skating on a covered call and the likelihood of that, we're really only worried about it going up above that strike price. So in this case, because we're using volatility, up above the standard deviation. So it's not a 68% chance, meaning a 32%, because there's a 32% chance then that it'll be the low standard deviation or above the high standard deviation. So really a 16% chance of being below and a 16% chance of being above. So basically it's 68% plus 16%. We figure there's an 84% chance of the stock staying below the strike price if we set the strike price at exactly one standard deviation higher. But there's a little bit of a ripple in the fabric of the universe here. If I'm selling a 28-day to expiration covered call, well, an annualized standard deviation, which is the result of 252 trading days, well, that doesn't do me much good if I'm trading a 28 calendar day, which is probably more like a 21 or 20-day trade, right? So we have to know how to de-annualize it. And this is important. In a simplified linear fashion, we divide the volatility of the option by the square root of the number of trading days in a year and multiply that times the square root of the number of trading days till expiration. And that's specifically till the expiration date of the option that we're considering trading. But hey, you know, us traders, we're always looking for a shortcut, right? Why not? Well, it turns out that if you just add 4 days to the 252-day trading days in a year, that comes to 256, right? 252 plus 4 is 256. So if we assume that there's 256 trading days in a year, well, that square root comes out to a nice round even 16. No decimals after it, just simply 16. So, that makes one of the numbers pretty easy. We don't have to bust out our calculator and use the square root key. We just take volatility and divide by 16. And then multiply that times the square root of the number of trading days to expiration. So we still got to bust out the calculator, but hey, you know. Once we have that percentage for the volatility, all we have to do is multiply it times the stock price and add it to the stock price. So for simplicity, we just take the stock price times 1 plus the de-annualized volatility percentage, right? Because if you multiply something times 1, that's 100% of 1. And then you're adding the de-annualized volatility percentage. So that's how much above the current stock price. Get it? Imagine a $97 stock. And then we have a call listed on it that has 28 calendar days to expiration. And its volatility, its implied volatility is 26. In order to convert the annualized figure to the 28 days to expiration figure, first we find the number of trading days in a 28 calendar day to expiration option, and that typically comes out to about 21. Then we just do the math. It's easy. The volatility is 26 divided by 16. It's always divided by 16 first. And then we multiply that times the square root of the number of trading days. So the square root of 21. So 26 divided by 16 times the square root of 21. In this case, comes out to 7.45%. It doesn't matter. I'm just using an example, but keep that in your head, 7.45%. So then how we make that useful for setting the strike is we do this. We're going to multiply the stock price, which I believe I said was $97, right? Times 1.0745. So like 100% plus 7.45% is 1.0745 in decimalized form. So 97 times 1.0745 is $104.23. So we would put, if we're using volatility to do this, and I'm not really 100% recommending it. This is a technique that a lot of people use, and you should be aware of it. I think there's better ways, but this is pretty important to understand. So if the strike price models out to $104.23, well, guess what? There's not going to be $104.23 strike price. There's probably more like 104 strike price or 105 strike price. So we're always going to have to round a little bit to the nearest available strike price. But the idea is that if the investor could sell the calls at $104.23 strike price, the investor would have an estimated 84% chance of skating on the call. A lot of traders do this, but the reality of it is, who really cares that there's an 84% chance? That's totally congruent with the amount of premium you take in. Whereas using something like resistance or RSI is not related to the premium that you take in. That gives you that bump in the road. That gives you something that actually puts an edge on your side. This just kind of gives you the trivia of, oh yeah, it's an 84% chance. And there's kind of another problem with using volatility. And that is, well, which volatility? Are we going to use implied volatility, or are we going to use historical volatility? You would think implied volatility would be what people use, right? And some people do. A lot of people do. That's considered the market's expectation for the future volatility of the stock. You ever hear that, right? Well, there's a lot of noise in the volatility market. Implied volatility is determined by supply and demand for options, buying and selling. It's not really a collective estimation of future volatility. It's not. So I argue implied volatility is probably not the best approach. It's pretty much guaranteed to always be wrong. You can use it in conjunction with some of the other things we talk about, but it's going to be wrong, which is actually good because that means you can get a volatility edge. We'll talk more about that. We've already talked some about that in previous episodes, and we'll continue in the future. Okay, so what about historical volatility? Well, that's the past, right? If you believe that during the life of the call option being considered to trade, that the stock will experience volatility with the exact same amount, the same volatility intensity that it has over the past month, well, then historical volatility would be the right one to use in this case, right? But that's not really a reality most of the time either. Most of the time, either there was a volatility event during the last month, like earnings, or there will be before the expiration of the option, which maybe it's 2 weeks, maybe it's a month, but we're already talking a half or 2/3 of a quarter if we're talking 6 or 8 weeks, right? I mean, a quarter is only 13 weeks. So the expectations for future volatility are probably not going to match exactly the volatility from the past month. So there's nothing wrong with using volatility as another bit of information, as long as you respect that it has its limitations. And in a lot of ways, too, the whole concept is kind of weird, too, because, okay, if there's an 84% chance of staying below the strike price, well, that's pretty arbitrary, really. I mean, you don't think it's arbitrary because, oh, it's standard deviation, but it is arbitrary. What's the big deal about 84% of the time? What about 80% of the time? What about 87% of the time? Or 73% of the time? Why is 84% so special? It's not. It's arbitrary. So it just gives us a probability and doesn't express an expected return, positive or negative. It doesn't add edge in and of itself. It only is useful as a tool when we consider it against the annualized static return of the covered call and the perceived risk of the stock falling too much too, which is not really part of that calculation. Range-bound indicators on stock charts can be useful for setting strikes for investors with the skate objective. Understanding what sort of range to expect and then setting strikes beyond the range, that can provide an edge when done right, if the correct indicator is used. But here's the thing. I set out on a mission to find an indicator that could help me set the strikes with covered calls. And of all the indicators out there, you know how many I found that are ready-made out of the box, or even with just a small slight change, are useful for trading covered calls? Exactly zilch, zippo, nada, nil, none. And I looked at some. I looked at Bollinger Bands. I looked at Keltner channels, and those are two of the most commonly used range expectation indicators. They're very popular. But in my quest to seek more edge, they didn't really help. So what I did is I created a custom indicator. And it's funny because many years ago, many years ago, like 20 years ago or so, I remember talking on the phone to somebody from Thinkorswim, and this was when they were a much younger company, way before Schwab, before TD Ameritrade, I think, bought them. Before InvestTools, maybe too. God, remember that? Holy cow. And, you know, they were trying to kind of shore up more business like any other company does. And they're like, Dan, why don't you create a custom indicator? You know, then it'll have your name on it. It helps our customers have something that's useful. They see your name. It helps you. It helps people know who you are. And I was like, yeah, that's a great idea, but I don't know what to do. I don't have an idea for a custom indicator. This one came about by necessity because nothing else worked and I needed something that worked. This is specifically designed for the technical analysis of stocks for covered calls and cash secured puts. I call it the price history anchored strike indicator, PAS, the PAS indicator. This I've created, I haven't really rolled out just yet. My friends at Metastock actually helped me out a lot with it, and it will be available first on Metastock, but we're not quite there. I need about another month or so. The PAS indicator uses a calculation that's similar in concept to the average true range, ATR. But instead of calculating the ATR per period and smoothing the average, it's calculated over a period of time that matches the number of trading days until expiration of whatever the options candidate for trading the wheel I'm considering has until expiration. Then what it does is it draws on the chart upper and lower bands that indicate that range, basically a range that it hasn't moved that far within a certain period of time that's congruent, equivalent to the amount of time I plan on holding the option. And there's a bit more to it, but that's the gist of it. I will soon make this available to people, but we're not there yet. Lots of work to do before we get there. So imagine you own 100 shares of a stock that's trading at $93.37. The stock I was looking at and thinking about when I wrote this in my book was OKTA, OKTA, trading around $93.37. And it was range bound for several weeks. It went up a bit, down a bit, up a bit, down a bit, but it was kind of in a range. So if you're considering it for a potential covered call candidate with the skate objective to not get assigned, I mean, the first thing that I did is I did some fundamental analysis, which is maybe less important when it comes to skate analysis. And I did some volatility analysis to see that the options were properly overpriced, not, or at least not underpriced. And then I started looking for a covered call, and I wanted one with a strike likely to be safely out of range that the stock is unlikely to move above during the holding period, or at least the anticipated period that I plan on holding the option. And even though I would probably close it early, I just assume that that's the expiration day. I assume that I hold it all the way till expiration, even though I won't. There was resistance of that stock at $105 a share. There were several inflection points that you could connect as a horizontal line at $105. And the upper PAS band was $104.26 on the most recent trading. So that was actually kind of worked out perfectly, since what it did is it supported resistance. That's kind of a weird way to say that, supported resistance. It confirmed resistance because it was another piece of information that also told me, hey, it's probably likely to move above basically the same level. And that price indicates the moving average for the upper threshold of the range going back 20 days, which I was looking at a 28 calendar day call, so 28 trading days. That's about what we're talking about. If between now and expiration, the stock doesn't move higher by the full length of the average 20 trading day range from the past 20 trading days, the call that is sold at or above that value is going to expire worthless. Of course, same thing as we talked about with volatility. There's not a $104.26 strike, right? So we have to round it, and it just worked out, gosh darn perfectly, that rounding it brings us to about $105, which is also where there is resistance, inflection points. So that's great. We've got a level that we like, but what's next? Well, we got to know, is the call worth selling? Let's say we can sell it at a 28 calendar day 105 strike call at 76 cents. Well, what's the annualized yield if we skate? Annualized yield, we've talked about this in the past, and those of you who are paid subscribers, you have a PDF printout of that, which is posted on our Substack, where our paid subscribers get all that stuff, as well as the articles I write pretty much every week. But the annualized yield when it comes to covered calls is just the call time value divided by the stock price, annualized. And I just annualize with calendar days times 365 divided by the calendar days to expiration. If we could sell that call at 76 cents, divide that by the stock price of $93.37, and then annualize that, don't worry about the exact numbers. Long story short, comes out to 10.61 annualized yield. So that means if the 105 strike call expires, this covered call adds an extra 10.61% in returns. Win, lose, or scratch. We make money on the stock, but we skate. We make an extra 10.61%. We lose money on the stock, but we lose 10.61% less. You got a big, big cushion. So what if the stock does move more than the calculated range? What if it busts above that 105 strike price? The calls are in the money. Well, you have two choices, don't you? I mean, look, if this is a skate objective trade, I mean, you can do one of two things. You could let the stock get assigned and take the win. You make money on the stock and you get an extra 10.61%. I'll take that. Sometimes I still want to hold the stock. And in those times, that's just when I roll. If I have no bias towards keeping the stock, well, then, yeah, I'll accept assignment. And then that's when I concern myself with the if called return. The if called return, which is a percentage, is the call strike price minus the stock price plus the call premium divided by the stock price. If called return percentage, call strike price minus stock price plus call premium divided by stock price. That's it. And that would end up being 13.27% in this case. And that is during this 1 month period, not annualized. You annualize it as something different. But I honestly just don't like to annualize the if called return. I just find it to be, I don't know. I don't, but there's nothing necessarily wrong with it. So if you have a bias for keeping the stock, though, you don't want to get called or assigned. If maybe I'm holding the stock in an account that is taxable, like not an IRA, and I happen to own the stock from years ago at a much lower cost basis, I might not want to get assigned and sell the stock and have to pay a huge tax bill. And keep in mind, it's the option holders, the traders who are long options, that decide whether to exercise or not. We don't have a choice in whether we get assigned. We can only try and avoid it. So it's possible to end up selling the stock even if you don't want to. So you got to be pretty proactive. You can't always avoid assignment guaranteed, but most of the time you can if you're proactive. Basically, as soon as the option's in the money, that's a great time to roll the call to a higher strike price, maybe out to a further longer dated expiration to attempt to avoid assignment. The old net zero roll, that'll take great care of you. Talked about that. But any up rolling or up and out rolling, it works fine. It really doesn't matter if you do an exact net zero roll, it doesn't matter. And we're going to talk a lot about management in future episodes. And that about wraps it up for this show. But before you go, make sure you're subscribed to this show on your favorite podcast platform, Spotify, Apple Podcasts, whatever it may be. And if you would be so kind as to leave a comment, that I would surely appreciate. Let me know what you like or what you'd like to hear more of. Until next time, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read Characteristics and Risks of Standardized Options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.